Hey guys, welcome back to a new video. I'll get this up again. Here we go. Welcome back, guys. This one's all about Singapore versus Hong Kong. A lot of people, especially family offices, especially operations that do stem into Asia Pacific regions. We always have to speak about Hong Kong and Singapore. So I just thought I've got many Hong Kong companies from operationals to holdings. Singapore is a very good option as well. So I want to take you through the difference. So why Singapore and Hong Kong? So we basically have in three tiers of companies, and we have onshore. This is for Asia Pacific region. We have Australia, Japan, South Korea. Again, these are full tax, heavy compliance, and not ideal for holding structures. As when we compare to tier two, we have the BVI, Cayman, Seychelles. They're typical offshores. We have limited banking, limited opportunities in banking that are holding only, not operational. As with the mid-shore, which is the sweet spot, we do have Singapore and Hong Kong. Okay, it's the territorial tax system, deep banking, and strong treaty networks. Okay, so really key three levels of thinking. Get your mindset into these three levels of thinking right here. Now, when we compare a PT versus a Hong Kong Limited, again, they're very similar. Again, the directors, and one must be a Singapore tax resident, which is a little bit different to Hong Kong, as you can see. Basically very similar across the board when we just simply compare them side by side. Okay. Now, when we actually look at the key takeaways, as you can see, the nominee usually adds $2 to $4K a year and requires one Singapore resident director, which is also good for substance reasons. As a Hong Kong is more of I would say an operational company. Yes, it can be used for IP holdings. Yes, it can be used for actual holdings. But if you do want that regional presence, you do want that substance, and you need that substance, then Singapore could be a great option. Additionally, a point which I was speaking with a client earlier, he's currently got a few companies with us, and he is going for funding, and he's looking at US markets, Hong Kong markets, Singapore markets, and Singapore was the best choice for him. Again, every situation is very unique as well, which is key here. Okay, so one is best for remote founders and huge travelers who are jumping between these regions. And the other one is more for founders with a regional presence. Okay. So additionally, when we look at the tax treatment, there's a little bit different. Now, Hong Kong is pretty strict, but it's territorial. Okay. So on the first, as you can see, 8.25% on the first 2 million Hong Kong dollars and 16.5% on the rest. Whereas in Singapore, we have a flat 17%, but again, there is exemptions with that territorial system. If you did want to actually learn these systems, you can simply apply to become a client below. We can have a simple Teams meeting or WhatsApp phone call, and we can go from there. Again, there's no VAT in Hong Kong, which is massive, huge difference, but there is a startup relief on Singapore, and there isn't in Hong Kong. So again, huge difference right there, huge difference. Again, foreign income must meet specific exemption criteria on remittance. Which is a key thing to actually focus about with Hong Kong. We have to apply for the exemption. And again, it's quite easy to do so as long as you're working with the correct team. You've been structured correctly. It is an easy task to actually do. When we look at, the actual critical tax differences, profits not arising derived from Hong Kong is not taxable, and that is a full stop right there. No remittance basis, no conditions on foreign income. If value creation happens outside of Hong Kong, the profit is exempt. Whereas when we compare it to Singapore, there's many myths around Singapore. Okay, foreign income remitted into Singapore may be taxable unless it qualifies for the exemption. Okay, so exemptions. Income tax on 15% plus in source and country and benefit to the Singapore company. Again, BVI dividend rate may not qualify, about 0%. And again, if the turnover is beyond 1 million Singapore dollars, there is a 9% VAT GST charge. So the bottom line is Hong Kong is much cleaner for pure offshore profits, while Singapore has a lot more conditions, but Singapore then comes with better banking, which we're probably going to go on to shortly. Okay. So in terms of a double tax agreements network, let's say, again, Singapore has a lot more, okay? And again, with India very strong, both of them, China very strong. But again, it's extensive across the EU, as with Hong Kong, it's pretty narrow, if you want the truth right here. And US coverage, no, there's not with Hong Kong. So you can see there's a huge difference between those two tax agreement networks right there. Now, in terms of banking access, Singapore is a clear winner. Okay. For example, you can onboard with Revolut in Singapore, but you can't with Hong Kong. And that's obviously because of trust issues, money laundering issues. And again, Hong Kong is much more of a haven when we compare it vice versa to Singapore. Singapore is much cleaner, as we would say in the banking world. Okay. So the thing is banks obviously need substance. And again, that also comes into the styles of how much presence do you have in Hong Kong? Are you making choices from Hong Kong? Okay, so the income is now sourced from Hong Kong. Now the tax exemption potentially could go out of the window. But what it is best for is Chinese trade, multi-currency treasuries, and Asia Pacific, just online trading companies. If they're doing this of Thailand, the Philippines, Australia, as well as London as well, could be great in Hong Kong. And so when we look at Singapore, Singapore is the new number one in the world. Again, it's much higher in terms of compliance. And again, it's a very, very clean entity. It's like the new London, if that makes sense. It's a very clean system. There's a huge investment there. It's now the home of family offices. And again, it's got maximum credibility especially when we compare it to Hong Kong, and it is trusted by counterparties, investors, and other banks globally, as well as other business reasons as well. It's much more trusted for when we compare it just against Hong Kong. So it's best for international credibility, investor-facing structures, and regulated businesses. So if you are raising capital, Singapore could be a great startup to actually enter, especially in the tech software world. Now, substance requirements, again, is a little bit more lenient in Hong Kong with Singapore. Again, key decisions have to be made by the Singaporean directors, and there is an actual operational footprint within Singapore, okay? And not just nominee directors, there is real substance there, and there's obviously a lot more due diligence that is done. As Hong Kong can essentially act as your new Wyoming LLC, typically speaking, and again, as you will learn, there is accounting on both of these, there is audits on both of them as well. So that's some substance requirements right there. Let me move on to audit and compliance. Again, it is required generally across the board. When we say small exempt, that's a very small company that's basically been not trading. Now, in terms of the actual annual returns, again, they are both required. Tax filings, both required. And you can now see, yes, Hong Kong is a cheaper formation, but you might see increased costs over there. But basically, they're very similar. But you might end up paying between 2 and 3K extra. As a Singapore small company exemption is material savings for an early stage business, an early stage startup, especially in tech. Now it's very common. I've seen them a lot. Okay. Now, when we look at the real costs, we can see that Singapore potentially can be cheaper, which is very surprising. But then again, they do have that headline tax rate. So it's really a very unique situation. And again, if you did want to learn more, it's just a simple overview where you can compare a company against the other one, then yeah, you can expect to spend more money in Hong Kong on a total situation. Now, which one should you choose? Potentially both, okay? That's why you should probably jump on a call. You can become a client by doing hpt.group/apply. But again, the strict territorial tax in Hong Kong versus the Singapore, which is it's a much more credible solution in Singapore, much more great for investor facing, especially if you're looking at raising funds or selling a business. Singapore is the new Hong Kong, I would like to say, and it's where most businesses are entering in nowadays. If they don't want to be in San Fran, then they're probably going to be in Singapore. If they don't want to be in London, they're probably going to be in Singapore. They don't want to enter the weak European markets, they're probably going to be in Singapore serving the world as clients, okay? So again, lots of people use both, especially as residents. It could be great to be a tax resident in both as well. And it's the two most expensive places in the world to actually live technically on a ground basis solution. Yes, we can look at Nassau in Bahamas, we can look at Monaco, but on the general, these two are mad business centers, really, really good business centers. And I hope you enjoyed this basically direct comparison. They're very similar, but obviously there is a little bit of difference. And the main thing is Singapore is a lot more credible. So other than that, guys, hope you enjoyed the video. Over and out, and I'll see you in the next one.